Good day, fellow investors. One of the questions that I often get is, Sven, how do you assess the quality of the management when it comes to investing? Of course, the quality of the management is reflected into the performance of the business over time. And then you get a feeling about that management culture, whether they do things or they don't do things that well. That's just one factor. Later, you compare it to price, and then you see whether something is cheap, a low risk, good buy, despite the management, depending on the value of the assets or whatever, or it is not to buy no matter what the management does. In that discussion, I analyzed telcos recently for my research platform, looking there into the shadows of the businesses that are cheap, and one of the cheapest there is Vodafone. Because if you look at it, 9.6% dividend yield, price earnings ratio of just 2. So let's dig into the business, the management culture, compare it to the investment risk and reward, and this will then help you also get a better feeling of how to assess whether a management is great, isn't lucky, or simply the corporate culture doesn't fit. If you look at Vodafone, it was bad over the last 20 something years. There's just a dividend, but then you have to keep in mind that the pound lost another 40-50%, especially in the last few years on top of the Brexit and everything. So a bad situation, but a bad situation also creates opportunities. So let's see if Vodafone is as cheap as it gets. The issue with telcos is that in the last decade and more, telcos are the businesses that invest the most. We had 3G, 4G, 5G, fiber, 1 giga, bliga, booga, vaga, who knows what. But those companies invested a lot and constantly needed to upgrade their technologies. Therefore, their return on capital employed is one of the lowest compared to the capital used. High capital necessities, low payouts, and therefore also no growth in profitability, high competition, a bad environment, and investors don't really like it, and therefore also the stock performances in the last decade have been really dismal. Now, if we look at Vodafone, we have Germany, Italy, something in the UK, I think just 10% of EBITDA. They have 50% of Vodafone Ziggo in the Netherlands. So always something diversified business there. Of course, South Africa, Egypt, Mozambique, a big business there, growing. Other Europe, practically well covered, globally diversified business. But if you look at the presentation of the company, when you see this in a presentation, turnaround, transformation, change, how will they do that? That means that the business is in trouble. And if you look at Warren Buffett's conditions to buying businesses, he always says, we are not interested in turnarounds, no matter how cheap those are, because there is a reason why a business is in trouble, and that's the reason also why it is cheap. But then you are betting on a turnaround, and the turnaround does also depend on the corporate culture, because the management that was there created the situation, and if they didn't change it in the last 20 years, why do they think they will change it in the next 2-3 years? Again, must change, become more profitable, compared to others. Return on capital is below their estimates. And what will change? They will focus better on the consumer, back to basics, leaner organization, growth in portfolio. They will suddenly do everything. But if you look at the numbers, like declining, flat, return on capital employed, depending on how you calculate, especially post-tax, is very, very low. Just commercial note here, I have a research platform. For those of you that don't know, there are my topics, portfolios, strategy, timing. I send an email every week with investing my money. The goal is to compound long term in a value investing international way. I would really appreciate if you take the 21-day money back guarantee, check everything, and then see whether it will add value to you in your financial lifetime. Let's go back to Vodafone. Germany going down compared to other companies that are not going down there. We will soon discuss T-Mobile in the S&P 500 overview. Again, Italy, okay, the UK, I think they had pricing, of course, but this is down. And then also Spain, etc., etc. So there are negative trends with the company. And if you look at it all, at the end, when they adjust everything, the free cash flow is 1.4 billion. I think that is euros, this is pounds, so 20, what will be, 27, something 25, depending on the day. But that is a very low free cash flow yield, which means that they need to take debt to finance that cash or sell things. They need to invest, of course, but they did sell Vantage Towers, part of it. So they sell the goods, the diamonds, to cover for the bad things. Then things don't look as good as it is. And their focus is to fully maintain the dividend, which is interesting, but I don't see more than the dividend. I would see something better if there is a complete turnaround in the telco industry, but that's something that's unlikely to happen. It is highly competitive, and those companies that have opportunistic managements that know what they are doing, those will do okay. And then you can get them at a cheap price. But those companies that have not so great managements will not do okay. That's simply the fact, and they will continue to invest huge amounts of money, do transactions, buy, sell, with low returns of capital. And this is the new CEO, 29-year company veteran, Margherita Della Valle, will be the new CEO. So after 15 years of terrible performance, they decide to go with what is already there. And then discussing those qualitative issues, there is no ownership. So the management decides how and what. There is no owner of the company that sends them to hell and decides to change things. So it's about themselves. That's why they choose themselves to continue to make money. They don't really care. They have huge packages. Nobody wants to do the hard things. Status quo continues, and therefore they are declining compared to others. Increasing debt pile, they make huge efforts by using more debt acquisitions to achieve growth without effort. And dividend at all costs, high debt, because it's easy to borrow money and think you're smart. And therefore, there is this such a corporate culture that I don't know whether there will be better. If there is a dividend cut from Vodafone next year because of financial situation in Europe, the stock will go down another 50%. Very easy. So I'm looking at this a little bit too complex, weak cash flows. There are telcos that have similar or better cash flows that are trading at a third of this. You can check my research platform for that. Vodafone is not for me, but we are learning and we'll discuss more of these companies. In the future, the key point here, if the management is bad, you simply feel it immediately and there is no point in discussing it, nor the stock nor the investment. That's why you rarely see me discussing the management.